This is level 2 of the CFA program, topic 2, quantitative methods, and the reading on machine learning. You might remember that we had a reading back in level 1 on this very topic, but I can assure you that this reading is way deeper and way broader than what we learned back in level 1. Before I show you the LOSs, let me lead with an example. Let's suppose I'm a researcher and I collect data on hundreds, maybe even 1,000 publicly held corporations that trade on the major exchanges. And I want to explain changes in dividend. I want to come up with a model that's going to say, all right, I would like to be able to predict which firms are likely to increase their dividend, which firms are likely to decrease their dividend. And so if we go back to that simple linear regression reading that we have, what might I do? I might come up with a model in which my independent variable is change in free cash flow. That might be one good independent variable to explain changes in dividends. But then we moved on to multiple regression, and maybe I want to add some extra variables in there. Maybe I want to put a return on equity. Maybe I want to put a leverage ratio in there. And I could even add a dummy variable, 1 if the board is a majority of independent directors, 0 if it is not. And if I do all that stuff, remember I'm collecting hundreds of data points here for lots of these firms, I have to start worrying about things like multicollinearity and heteroscedasticity. And then I could go to that last reading that we have. I could do this in a time series. And then I have to worry about serial correlation. Remember those tests we did for autocorrelation? And essentially what happens, we have this model and we're trying to use that model to describe reality so that we can make an estimate or a prediction of what might happen for new firms that come into our analysis to be able to determine, is this firm likely to increase or decrease its dividend over time? Well, now imagine that instead of collecting hundreds of data points, imagine that we can collect and we have access to thousands or tens of thousands of data points. So what was my first independent variable? It was free cash flow. And think about all that goes into free cash flow. You need an estimate of revenues. So you need an estimate of P times Q, prices and quantities. And you need expenses. And so you have all kinds of expenses in there, all kinds of operating expenses like wage expense, and tax expense and depreciation expense. I'm lumping all those together in expenses. And then you have, leverage ratios and return on equity. So imagine you have all of those data points. So instead of having just, several hundred or maybe 1,000 data points, now you have hundreds of thousands of these things. And so you try to put it into an Excel spreadsheet, and your spreadsheet, first of all, goes like this and goes like this. You can't keep track of it. Well, imagine that regular old softwares can't even keep track of this. So that's why we need machine learning. We need these extreme engineered algorithms that are going to be able to help us process all of this data. Because after all, if we believe that free cash flow can predict and explain the changes in dividends, then we must believe that all the components of free cash flow are at least slightly important in explaining those dividends. So that's what we're doing. And you'll see this through the learning outcome statements. And so that first one is really probably a general one. And I think you probably don't even need the bottom 4, because if you can distinguish between supervised, unsupervised, and deep learning, you'll have to describe all of those things. And so that first one is super important. But then look at the third and fourth one. I think this is where the meat of this reading lies. Describe supervised machine learning algorithms. And then we're going to list, a whole bunch of these methods. And then unsupervised machine learning algorithms, we list another bunch of these methods. So I want you to think of these as the next logical step to linear regression, multiple regression, and time series regression. This is the next step. So of course, it's responsible and required for the CFA Institute to have these kinds of readings. Here's a brief recap from level 1. I'm pretty sure I just explained all this. Subset of artificial intelligence. Of course, I think there was a great movie out on artificial intelligence, but whenever when I hear these words machine learning, I always think of Arnold Schwarzenegger and the Terminator movies, and how, I don't know if this has anything to do with the reading, but Arnold Schwarzenegger, he did learn over all of those 5 or 6 movies. He even developed a sense of humor. What a great addition to that movie series. Anyway, look at the third teardrop point. Machine learning replaces standard statistical approaches when we've got high dimension data, vast volume of data, and then nonlinear relationships. Of course, if we have this big old Excel spreadsheet, there's probably not going to be an assumption in there that all of those variables are linearly related. All right, some quick vocabulary. You probably remember this. Target is the dependent variable. The independent variables are known as the features. And then we need this hyperparameter. Remember from some of those previous recordings inside of this topic where we were doing a test, and a lot of those null hypotheses tests are that beta, the slope coefficient, is equal to 0. But I did mention to you that in some tests you might want to decide if the beta of a particular stock is equal to 1. So that's kind of like a hyperparameter. It must be set by the researcher before learning begins. You know, we think this large stock probably looks an awful lot like the S&P 500 index, but we want to test it. Now, the hyperparameters, as we'll see going through this recording, is that they can take on any value, right? But they must be set before learning begins. And then we have this training data. So we have all this training data to, you ready for this, to have the machine go through this data, process it, put it into different components or clusters, and then use that as training to be able to have somebody else come in and say, okay, all right, this is what we've learned, and then does it apply to new variables? All right, here we get into really the meat of this. Types of machine learning. So supervised machine learning. This is pretty much what we've done in the last several recordings. Labeled training data that infers patterns between the inputs and the outputs. All right, so look at that second arrow point there. The algorithm works out the f in the equation. So there's y equals f of x. So this is what we've really been doing in our regression analyses, but now we've got huge data sets, right? So look at the last arrow point there. The function is trained to predict the output variable whenever there is a new set of input data. So imagine my big old matrix of data where we're trying to predict changes in dividend yields, and we have this learning model, we have this machine learning, and it has some outputs, right? It has some coefficients, it has all that stuff that we're used to, plus some extra things. But then we throw in a firm, right? So here's a firm that went through an IPO, let's say 5 years ago, hasn't paid a dividend, and then all of a sudden it announces that it's going to pay a dividend. So now we can put that thing into the model, and we'll see how well it predicts what that change in dividend is going to be. Now, classes of supervised learning. So we have regression problems. This is what we've been doing before. So look at the example, using historical stock market returns to forecast stock prices. All right, that makes perfect sense. Classification problems. So what we're trying to do is to categorize these into distinct groups. And so the example there is, email, safe or suspicious. But how about this one? How about a classification issue in which we're a financial institution and we're hiring new financial risk managers, financial managers, and wealth managers, and we want to put together a model that's going to predict whether or not an individual who we hire is going to commit some kind of securities fraud or embezzlement or any kind of a fraud. So that would be a classification, can I use those terms there, a safe hire or a suspicious hire. Sure, there are lots of financial institutions that wish they would have been able to prevent some of these scandals that have occurred over the years. All right, unsupervised machine learning does not use labeled data, right? We have this set of inputs is used for analysis with no corresponding target. So what happens here is that instead of putting in the dependent variable of changes in dividends in my original model, we throw that out, or we just put it in and say it's another set of an input. And then what we do is we try to determine whether there is an underlying structure that is not dependent. It's not given on any kind of a target variable. So here are a couple of examples. Dimension reduction. So imagine this big old thing. We got this big matrix, and what we want to do is say, there are probably some of those variables inside of that matrix that are related. Maybe they have lots and lots of correlation, and we want to try to reduce the number of inputs so we can reduce the complexity of the data. Here's the example that I thought of in my brain as I was reading through this. Those of you who are lucky to and blessed to be parents, and especially those who have 4 or 5 children, you have these children and hopefully they all have different interests, right? And so you have some who play music instruments, some who play sports, and some who are on the debate team, and some, right? And so you have all these children after school. You have to get them to all these different practices, and you have to worry about feeding them, and they have to go from point A to point B, make sure they have their musical instruments or their hockey stick, whatever it is. So think about that big old matrix as a parent. If you were trying to micromanage, each individual child, like, okay, Betty has clarinet practice after school, and then after that, then she has to go to soccer practice. So how do I get her there? So, you're doing all this stuff. Well, dimension reduction, let me give you an extreme example. I'm guessing that you've been tempted to do, like I have been tempted to do, is just say to your children, okay, you're on your own. That's extreme dimension reduction. Of course, I'm not advocating that, but this is what you do. You say things like, okay, how about if we carpool? If we can carpool, and then the parent who's in charge of carpooling can be the feeder, bring in food. Well, we're reducing the complexity of this, and then we can manage our household a lot easier. So look at the example there, to simplify modeling and to reduce the file size. So that's dimension reduction. Clustering, on the other hand, is different. What we're going to do is ask our children, we're going to say, okay, how many of you play the clarinet or a musical instrument? How many of you play soccer or ping pong? And how many of you have jobs after school? So you cluster them, and then you're able to manage them individual clusters rather than that whole data set. So look at the example there. Cluster based on financial statement data. So how about my example with the dividend yield? So what I'm going to do is put these clusters here that have super high free cash flows, and have a cluster over here that have moderate free cash flows, and then maybe a cluster here of somewhere around 0, and then a cluster down here of negative free cash flows. Oh, now I can start seeing the relationship between the cluster and that change in dividend if I want to throw that in there as well. So here's a really good picture of the difference between supervised and unsupervised learning. So we have pretty much the same kind of data sets, but look, we're classifying them in there, so we draw the dotted lines, right? Clustering, we have them in groups. I think that's a really cool picture, and I think that will probably help you answer an exam question if you can visualize that on the exam. All right, how about the third part of this LOS, deep learning, a self-teaching system in which a computer learns from interacting with itself. So think about what this means, interacting with itself. So what it has to do is it has to then process all of this data in there, and then compartmentalize some of the data, run tests on the data, and then compare. Boy, can I call them samples in there? Compare each different sample test, increase the sample size, decrease the sample size, and then bring in, of course, it's our responsibility as the creator of the algorithm is to make the computer, force the computer, establish some kind of an algorithm in there so that the computer can learn from itself. So that, look at the second diamond point, to make predictions about new data. And of course, there are lots of lots of complex tasks where deep learning is applied. But I'll go back to a financial example that I just used a few moments ago. I mean, detection of fraud. Isn't this a super big problem? How about in wealth management, finding the optimal portfolios for each individual client with a unique set of risk and return objectives? Yeah, look at the last diamond point down there. Computer learns through trial and error and reinforcement learning. So this is continuous feedback. So every time there's a test, the computer then learns, the machine learns from it, just like Arnold Schwarzenegger learned over the course of those movies. How about overfitting and underfitting? And so this is really the extreme example that I just gave you as a parent saying something like, okay, children, you're on your own, or trying to micromanage every decision and every meal and every transportation problem that your children have after school. So look in the middle. So here we have time and value. So that's a simple two-dimension graph. And so look at the data. The data goes downward sloping, and then it bottoms out to a zero slope, and then it's upward sloping. And so here we have a robust fit. And there's a balance between the two problems here, the bias and high variance. All right, so let's go over to the left. So how about underfitting? So notice we draw a line. So this is what we would come up with if we were doing simple linear regression, right? We'd come up with a line and we would have a high biased error, which simply means that the data and the output that you have is going to have a substantial amount of bias in it. On the other hand, look over in the overfitting. And so this really is what the LOS is, describe overfitting. And so look at the model. I mean, if we're going at every point and we're drawing a little line in there, that means there's going to be a super high variance error because when we bring in a new one, right? So if this is my dividend change example, we bring in a new firm and test how well the model is, we're going to probably be way wrong. So that's going to be a high variance. So you can expect these new, right? These out of sample additions or tests to the training data, that they're going to be way wrong because we're overfitting, because you don't really know what's going to happen there to that next, that far right dot, whether it's going to continue in the downward slope or maybe it's going to go upward slope, or anyway. So that's important to know, difference between the high bias error and the high variance error. And so here's another slide giving you the example here. So the in-sample errors, so bias error arises from underfitted models. So this is going to be a bias when you're testing in sample. The model is not going to be able to accurately describe the data that it was fit to. That's high bias. So then the variance, so out of sample errors. And then there's a final one over there. I don't think I mentioned that on the previous slide. Residuals errors. So these are errors that occur that are not in sample or not out of sample, and they are just a result of randomness in the data. All right, so how do we do this complex? How do we solve the problem of overfitting? So two ways here. So complexity reduction, limiting the number of features and penalizing algorithms that are too complex. That makes sense. And then cross-validation, so carefully partitioning the data into a training sample, a validation sample, and a test sample. And so that wipes out the sampling bias. Let's take a look at one method of cross-validation. This is known as k-fold cross-validation. And look at that orange circle point there in the middle. For example, if k equals 5, the data set is split into 5 sections and folds. Now, as I was reading through in preparing for this slide, I noticed that the CFA Institute in this reading, they say K is usually 5 or 10, and there's no explanation for 5 or 10. So I'm guessing that somebody really important has done a lot of research on here and found that 5 and 10 are the most efficient hyperparameters. So I mentioned that just to look for that on the exam, a 5 or a 10. Sounds like that's an obvious one there. All right, so what does this cross-validation using k-fold mean? look at that first purple circle point. Reduces the problem of the holdout sample, which is the data set not used to train the model. So what we're going to do is we're going to split the data set into K folds or K sections, right? And what's going to happen is that each section is used as a testing point. And so, think about this way. Remember when we talked about financial institutions and the different kind of silos that they have. So think of these wealth management and retail banking and all those kind of different silos. Think of those as sections or folds. And so what's going to happen is we're going to try to find similarities when there. So the first section is the test, and then the rest are used to train. And then that's repeated over and over and over again. And then let's go back to my change in dividend example. If you have all these data points for hundreds of financial institutions, then you're going to test that, and you're going to solve. What this does is solve the problem of that holdout sample. All right, so this is divided into two categories: supervised machine learning. So we have regression problems, which we've talked about before, continuous target variables, but we're going to talk about penalized regression here in just a second, and that's going to be super fun to learn. And then classification problems, these are categorical target variables, and we'll talk about CART and random forest in 4 or 5 slides from now. So let's take a look at this penalized regression. Remember back when we did multiple regression analysis, we had the problem of adding an extra independent variable in which that increased the likelihood of some of the problems, violations of the assumptions, not least of which was multi-collinearity. When you add those extra variables, you get a higher R squared, and then remember we had to do the adjusted R squared. Well, now remember, with machine learning, we're not worried about any of that kind of stuff because we don't have those same underlying assumptions. But we still don't want to add variables just for the sake of adding them. So the question then becomes, how can we know if we're adding a variable that's going to add value to the model? Well, this goes back to our microeconomics days. What we're doing is we're just comparing marginal costs versus marginal benefits, right? You'd see me do this multiple times in many of the recordings. So now what we're going to do is we're going to say, okay, if I want to add this variable, whatever this is, to my model, the dividend changes in dividend. If I want to add, like the undergraduate degree of the CEO, whether it was an Ivy League school, a top tier school, or some other school, right? If I want to add that variable, what I'm going to do is I'm going to force a penalty into the model that penalizes the extra variable. And so what we have to ask ourselves is, does this addition cover the penalty that is imposed? So look at the last curved arrow point. Regression coefficients are selected in a way to minimize the sum of the squared residuals, which we've done 100 times before, plus the penalty term. So we're penalizing it, and we're saying, look, if you're going to be there, then you better perform. And I like to give sports analogies, and the greatest sports analogy I have is this relatively new statistic where they come up with this term. This is mostly for basketball players, where, okay, what's the score when you are in the game? Are you plus 10 or are you minus 10? And so, all right, we put you in the game, and if you're a minus 10, then you're probably not worth it, right? So we're minimizing the sum of the squared residuals plus that penalty term. And what this does, this reduces the concept of overfitting. So here, this is a really cool slide to address two of those LOSs. Now, one particular, let me go back here real quick. One particular cross-validation is this K-fold cross-validation. And then what we need to do is move on to this lasso regression. The least absolute shrinkage and selection operator is an example of a penalty regression. So I explained to you about the penalty. Now we're going to use a hyperparameter. This is called lambda. So you remember lambda begins with an L and lasso regression begins with an L. And so what happens here is that if we reduce this lambda all the way to 0, it's exactly like doing ordinary least squares that we've done before. But now we're going to make this lasso, look at in the middle there, so lambda is greater than 0. So when that's positive, we're going to penalize the addition of this extra variable. So look at some of those diamond points in the middle. It's a tuning parameter that decides how much we want to penalize the flexibility of our model. The penalty term, it has to increase with the number of variables, of course. And so here, this is a great exam question. As the value of lambda increases, the value of the coefficients reduces. And so what the consequence is, of course, we have a lower variance, and this reduces overfitting. So that's a great slide there to help you answer the question about lasso, about lambda, and about overfitting. And if you remember the reduction in variance, I think you'll be okay on those questions. How about the part of the LOS that asks us to explain a support vector machine? This sounds super complex, right? I'm pretty sure that Tom Cruise and all of his friends in the Mission Impossible movies used some kind of a version of this term. Sounds really complex, but it's not. Forget about the diamond points here just a second. What I want you to do is take a look down at the graph. Notice there's a line, right? There's a line down there. That's called the separating hyperplane. And then notice there are a couple of different classes. We have the circle classes that are unfilled and the circle classes that are filled over on the right. So that's a separating hyperplane. So there's the support vector machine. So this machine learning, what it does is it takes a look at the one class, it takes a look at the other class, and then it finds that separating hyperplane right down the middle. Now, this, of course, is a great illustration of two classes that are clearly, right, they're clearly not in the same class. So everything on the left of that plane is a circle. Everything that is to the right of that plane is a filled-in circle, right? So this is really a super simple example. But the way this support vector machine algorithm works is that it maximizes the margin between the class's closest points. And that should make perfect sense. Now, sometimes, of course, the empty circles are sometimes over on the other side and the filled-in circles are sometimes over on the other side. And so there's another method here that you can use called soft margin SVM. And there's also an algorithm where the relationship is nonlinear. So you don't have to, that hyperplane doesn't have to be a line. And remember, it's a plane, so there are a couple of dimensions in there. So it can be some kind of a curve to represent the nonlinearity of that model. Now, of course, let me go back here real quick. You know, I hit that word there. If you did see that last slide that I came away from, you know, what you're trying to do is separate two kinds of classes. So it makes sense then that the applications would be in binary classifications, like bankruptcy versus non-bankruptcy, fundamental analysis, oh my gosh, technical analysis. But let's go back to my original dividend example. So dividend changes, so we could have a positive dividend change versus a negative dividend change. But you can also use this SVM to classify the text. So if you go back here and imagine the empty circles are data points from the balance sheet of hundreds, maybe thousands of publicly held corporations. And the filled in data points are income statement information from those same firms. All right. So what you're trying to do is separate those two, and maybe they're not as easily separated. So you want to try to classify something from the company's annual reports into positive or negative sentiment. So let's go back here. So what did I say? The empty circles were from the balance sheet. So you could find out some positive things about that you can learn from the balance sheet, like, you know, just for example, you know, an increase in total assets. That might be good if we're looking for corporations that are increasing their size. And over on the income statement, we could look at revenues or expenses in that same manner. So remember this. I think this is a great exam question. So the SVM, so binary classifications, and be able to classify information from annual reports as either, hey, you know, we like this or we don't like it. Another supervised machine learning algorithm is known as the k-nearest neighbor. And unlike, what did I say to you back here, the support vector machine, that sounds complex. And it's not really. Here, the k-nearest neighbor, it doesn't sound complex, and it's not either. It's exactly what the name suggests. So think about all this data like here, and what we want to do is we want to say, okay, we have these little pockets, right? Maybe classifications, maybe we have some other groupings, and we want to know how near each other are they? You know, it's like you living in your neighborhood. You have your next door neighbor, and you got your friend who lives all the way at the other side. So k-nearest neighbor. Now, k, of course, is going to be another hyperparameter that we're going to have to determine before we use this algorithm. So here are a couple of important points here. Yes, use classification and regression, right? The idea is to classify a new observation by finding similarities, right? So think about similarities as correlations, but it's way more complex than that. We're doing it in terms of nearest, between it and its k nearest neighbors in that existing data set. All right, so this is non-parametric, remember that. So no assumptions regarding the distributions of the data. But here are the problems here. How do you select k? I mean, I've said this to you before in other recordings, but also in this one here. You know, when you have to pick a k, or you have to pick some hyperparameter, whatever it is, sometimes you're not really that knowledgeable about the entire population, so you have to guess. But of course, that's what we're being trained to do here, to make educated guesses, to learn from experience, etc., etc. In fact, in our choice of k, we're exactly like the machine. We need to learn as we go along. Here's a really, really cool example. So we've got, we have three existing classes. We have the yellow class and the green class and the orange class. And so, you know, even though we have 2 and 3 and 3 data points there, imagine that those are, you know, thousands or tens of thousands of data points. So what we want to do is we want to classify that gray point into classes, right? So we can do them into the yellow. Of course, we're calling that here lime green or green or orange. And so what happens is that we just get out our ruler. Think about how simple this is, at least to start out conceptually. We get out our ruler and we compute the distance between the gray point and all other points. Now here it's just a handful of points, but imagine it being hundreds of thousands of points. And then we go ahead and look at the data and we see who is the nearest neighbor, right? And so what we're trying to do is we're trying to find out, okay, is the nearest neighbor this far away? Can you guys see my hands? Or is the nearest neighbor this far away? And then what we're going to do is we're going to find that closest or that nearest point. So it looks pretty obvious here that we're going to classify that as what I called yellow originally, but we call this lime green. So think about what we can use this for. We can use this for bankruptcy prediction. We can use it for stock price prediction. So that has tremendous applications in technical analysis, right? Corporate bond credit rating. Boy, if we could predict what Moody's and Standard & Poor's and Fitch are going to do, you know, when they come out with that next rating, if we could predict that, oh my gosh, think about how valuable we would be as wealth managers. And then I really like this last one here, customized equity and bond index creation. You know, I'm a big fan of, you know, we're always tempted to say, all right, our portfolio is pretty diversified. Let me compare it to the S&P 500 index. But I've always thought, boy, that's probably not the right benchmark to use. I always tell my students, I say, look, you need to craft an index that is the exact same composition as your portfolio, but with different securities. And so you can use this K nearest neighbor. I mean, think about how cool this is. You know, if you have, you know, let me just pick a company like Johnson & Johnson. So that's in your portfolio. Well, what you want to do to create this this benchmark is that you want to go ahead and you want to find another company out there that's exactly like Johnson & Johnson, but is not Johnson & Johnson. And then that's the K nearest neighbor. So you can do that for benchmarks, but you can also do it for exactly what this says, customized equity and bond index creation. I mean, this opens up a whole series of possibilities. And so I think this is really among the coolest of of all of these supervised machine learning algorithms. I did tell you just a few moments ago we'd get to the cart. So we're doing a classification and regression tree. All right, so forget about the teardrop points there over on the left. Let's just look at this tree on the right. So there's our root node. Let's go back to my dividend change example. So that root question, that root node, let's go ahead and ask the question, all right, we have all these firms, and some lowered their dividend, some kept their dividend constant, some increased their dividend. So let's suppose that root node, let's suppose we want to look at this sample of firms that increased their dividend by greater than 15%. All right, so that root node, that root question is, all right, let's look at all the firms that increased their dividend by more than 15%. And then let's go down to the next decision. Let's say, all right, now what was one of those variables I gave you? Free cash flow. So let's take these two decisions here. Let's say, this is the first branch of the tree. Let's say something like, all right, let's divide these into firms in which the free cash flow increased by, let's say, 5% or more, and then increased by 25% or more, right? So if the answer is no, then we hit that terminal node, right? If it's yes, then we hit another decision node, and then we can throw something else in there, like, how about if we include board of directors, educational experience or something, and then we get to the next one. We have a yes or a no. So sooner or later, we hit the terminal node, and at that terminal node, we can decide whether or not this firm is going to have increased its dividend or not increased its dividend. And of course, I'm talking about a new firm coming into the data set. So we look at all of this and we learn from it, right? This cart, we're learning from this. We go through all these decisions and we say, okay, these firms are likely to increase their dividend by greater than, what did I say, 10% or 15%. And then you can imagine this cart model, this tree model. I mean, you can change those variables in there. What did I say, 5% and 10% and 25%? You can change those. But ultimately, what you're trying to do is figure out whether a new firm under evaluation, because remember, we're good financial managers. We want to know if this stock is worth adding to our client's portfolio. So we go through this model, we go through this algorithm, and we say yes for this firm, no for that firm, based on machine learning in which we have this huge data set. All right, so what about those teardrop points over there? All right, decision tree, we talked about that. Oh yes, you should have been thinking, okay, didn't we do this back with the Probit models and the Logit models? But this is way better than that. Yeah, look at the fourth one there. Searches and chooses the variable that minimizes the misclassification error. And then that chosen variable is used for splitting the observation. So what we want to do is with, what were my numbers there? 5%, 10%, 25%, whatever those numbers are, we want to make certain that we're classifying our firms based on those preconceived notions. All right, fraud detection, that's, we've done fraud detection in almost all of these applications. Simplifying the communication of investment decisions to clients. All right, so remember, we have to put together this gigantic investment policy statement. And so we're going to communicate the important things out. I mean, we're going to hand the policy statement to the client, right? But then over time, we need to communicate how these decisions have been made and how they're being changed. And of course, what we don't want to do is we don't want to send the client the entire policy statement every day with the change, right? So we just want to make sure that we do this in the most efficient manner possible. And then how about that middle blue bullet point? Generates consistent decision process in equity and fixed income selection. Oh my gosh, let me go back here to that note. So my example was a relatively simple one, right? Dividend increasing firms. And we want to try to identify which of those dividend increasing firms are going to be relevant for our individual clients. Every once in a while, I read something in the text of these chapters that really catches my eye. And such an event occurred when I looked at this ensemble learning section. The reading says something like, we really like some of these models that we've done, but how about, and wouldn't it be better, and how much more exciting would it be, and how more accurate could we possibly be if we combine these things? That's really what ensemble learning is. So look at this. It's a technique of combining predictions from a collection of models. And there are really two types of ensemble learnings. There's an aggregate of heterogeneous learners in which different forms of these algorithms are combined, and then they've got one voting classifier that is that theme, or that kind of extracts the important decision out of that data set. The other one is an aggregate of homogeneous learners in which you use the same kinds of data sets, but you use different training data. So you have the algorithm, but you have different training data. So there's two types of ensemble learning. Remember that, heterogeneous and homogeneous learners. Look at that second diamond point. Produces more accurate and more stable predictions than any single model. And that ought to make sense, right? Combine multiple learning algorithms. So we want to decrease the variance. That's called bagging. We want to decrease the bias. So remember, we had that one slide where we had the robust model in the middle, and we had the under and the overfitting there on the right and left. That's called boosting, decreasing bias. And then improved predictions, and that is called stacking. How about if we describe these in a little bit more detail here? So bagging involves taking multiple samples from the training data set with replacement samples, and that's why that's the bootstrap. We're going to do some bootstrapping when we do like maybe a bond with an embedded call option. And so the final prediction is based on the majority vote, right? So you have all of these different types of algorithms combined, and you take a majority, right? And so essentially what that does is it reduces variance. And this is what the random forest is. This is a special case of bagging. Booting, on the other hand, is made up of weak learners. And so this is the thought that I had as I'm reading this section about weak learners. I've always told my children that when the sports that they're playing is that you have to take risks. You have to try new things, and practice so you can learn from your mistakes, right? So you make a mistake, you make a mistake, you make a mistake, and then you get better at it, and you get better at it, and you learn it. And so here in this supervised machine learning algorithm, what we want to do is we want to avoid misclassification. So if we're a weak learner, we're probably always or regularly going to or systematically misclassify. So what we want to do is make sure that we avoid that as we move on through time. So this reduces variance and improves accuracy, just like the bagging did in the random forest over on the left column. But what it doesn't handle very well are data that's super noisy and data that contains a substantial number of outliers. So remember booting weak learners, and that gets you to stacking over here. Strong learners, and this is a second level machine learning algorithm. And so there's an optimal combination of base learners. I like to give sports analogies. So if we're trying to figure out about, let's say, the skill set of foul shooting in the NBA, we'd probably want to include Steph Curry, right, and Steve Nash, who's now a coach, but he was up there. I think he's second in all time after Steph Curry. So you'd have those two as strong learners, and so what you do is you combine those, and then you can pick a bunch of other NBA players who had above 90 percentile in their career, and so you get those optimal outcome with some kind of a majority vote. Now those guys are all really super foul shooters, so if they say something, it's probably going to come out to be a majority of vote. But think about how this would work with this model in predicting dividend changes, right? So we have some of these things, whatever they are, some of these algorithms are successful, and we want to combine those successful algorithms so that we get a consensus. Here's a slide that is a little bit more specific in these random forests. Let's go ahead and look through these circle points on the left. A large number of uncorrelated trees. All right, so look at the graph over there. I'm sorry, the illustration. So we have tree 1, tree 2, and tree 3, and a bunch of squiggly lines. So think of those as nodes or decision points, all the way down to some terminal decision. Now, these are uncorrelated, so that's important. However, tree 1 and tree 2, look, these things, we're not really sure we like them. They're abnormal and abnormal. But look at tree 3 over there. That's normal. So when you combine tree 1, tree 2, tree 3, even though some of them might be inferior, the combination of those, because they're uncorrelated, leads to a majority decision. Look at the orange circle point there, termed as the wisdom of crowds. So even if a model is not super successful, there's still something that can be extracted from it that can lead us to some kind of an optimal decision. Now, what are the applications here? And this is my favorite, one of my favorites here, factor-based investment strategies. Now, this is not the great example here, but let's go back to my dividend change. Suppose that we've got a collection of all this, a cross-section of stock returns for, thousands, tens of thousands of stocks. And we believe that dividend changes are an important factor, right? So we want to do a factor analysis. Well, what we can do is we can use this random forest, tree 1, tree 2, and tree 3, and maybe some other types of trees that are going to lead to a majority function. And then what happens is that we can identify those dividend-paying firms that should be included into a client's portfolio based on our factor analysis. All right, boy, that was long discussion on supervised machine learning. So let's switch over to unsupervised machine learning. All right, so just a quick review here. It does not use labeled data, tries to find patterns within the data. Now, what we're going to do is we're going to piggyback on a couple of things that we did earlier. Remember, we did dimension reduction and clustering, but what we're going to do is specifically address those now into unsupervised machine learning algorithms. So we're going to look at principal component analysis, k-means clustering, and hierarchical clustering. Now, principal component analysis, I'm pretty sure we talked about this back in level 1. Think about this Excel spreadsheet. It's really wide and really deep. And we know that there are relationships between and among lots of those variables inside of the data. And so what we want to do is we want to get out our vise and we want to squeeze it, right? Principal component analysis. So we want to reduce the dimensionality of that data set by identifying key components. We call those principal components. And what that does is it will allow us to reduce the necessary computing power to just those critical or those important core values. Now, these things are called a screes. So look at the scree plot over there. So component number, so principal components. So look all the way out the right, we have 12, but it's probably not going to be 100, but it could be 1,000. I mean, it could be some giant number, and we want to reduce that number to something that is more manageable. All right, and on the vertical axis, we have this eigenvalue, which is essentially, boy, don't tell your stats professors that I said that. Think of an eigenvalue. It's kind of like a standard deviation. It measures the distance from one place to another, but the eigenvalue is way more complex. In statistics, when we do a standard deviation, we have one variable like stock returns, and we can compute the standard deviation of one stock. But when we have this huge data set, we use the term eigenvalue because we're trying to minimize that standard deviation or the eigenvalue. So think of it just as a measure of volatility. And I don't think it would be a problem if you viewed this graph almost like the graph between systematic and unsystematic risk and the values of diversification, right? Along the horizontal axis, we have the number of stocks in the portfolio, and standard deviation falls. All right, so this is what we're trying to do. Same thing here. we're trying to reduce that eigenvalue to some manageable number, right? A manageable volatility. And so note that as we reduce these things all the way down to 1, that eigenvalue is super high, right? So we pretty sure that one component, one principal component is probably not enough. But do we really need the 11th or the 12th or the 15th or the 18th? And so what this PCA will do is try to help us get somewhere that's manageable, somewhere around, I don't know, 3 or 4 or 5. We've drawn that red dotted line in there so that, maybe that's our kind of hyperparameter there for the eigenvalue. So look at the last circle point. A lower dimension data set makes machine learning models quicker to train and easier to interpret and reduces overfitting. I think that last circle point there, that's a great exam question. Clustering here. Look at those two illustrations. There's poor clustering, and you can see that there. You have green and blue and orange, and that is a classic definition of poor clustering. But then ideal clustering, of course, the green and then the orange and then the blue, they ought to be their own unique cluster. So the question then becomes, how can we organize the data points so that we have clusters that are cohesive and separate, right? We want the clumps. So we want a clump here and a clump here and a clump here. If we have one giant clump, then it's no good, right? So let's go ahead and look at K means clustering, right? K is going to be the hyperparameter again. And so the reading suggests, maybe 3 or 10 or 15 or some number. So we're going to have to pick K as our hyperparameter. And if we go back to my dividend change example, we may have a sense that we want to cluster those according to, some variable. And maybe we'll say it's 4 clusters, and we'll have to base that 4 on some kind of experience. And so what this unsupervised machine learning algorithm does is it takes that entire data set and then it puts them into the 4 clusters in my example, and it'll put it into 4 clusters, and then it'll do it again, and it'll put it in 4 clusters, and then 4 clusters and 4 clusters, and it'll do this a million times. And each cluster, notice in the illustrations up there, there's a little black dot, and so each cluster is going to have a center point that's called the centroid. And so what we want to do is, are you ready for this? Like minimize the distance between the centroid and all of the outliers, because of course, you or I could just visualize this data. Now we'd have to do it in several dimensions, but in this illustration here, it's just 2 dimensions. We can visualize the clusters that are around the centroid. That's really not a problem. The problem is trying to figure out where those outliers go. Look at the orange. Some of those orange, boy, they could squeak over into the blue. But if we're minimizing that distance, then the algorithm will say, no, that outlier is definitely an orange, and this outlier is definitely a blue. So here's just a quick slide on a flowchart of exactly what happens during the K clustering. So we select K centroids, right? And then we observe the closest, calculate new, do this over and over again, reassign, look at reiterates, and then reassigns, and reiterates, and reassigns. And so look at the bottom there. The algorithm has converged and minimized intra-cluster distance, thus maximizing cohesion and separation. I use those words just back on this slide. So look on the right illustration. You clearly think that the orange and the blue and the green, they're separate, right? And they're cohesive in that the orange is right there by itself and the blue and the green. How about a hierarchy of clusters? All right, so we can do this one of 2 ways. We can do a bottom-up approach. And so this sounds like it's a really long process. Each observation is its own cluster. So let me go back here to this. So how many observations we have in there? Who knows? Let's say that there's 400 observations there. So each observation is its own cluster. And then you do, okay, which one is near, right? Which one is near? Which one is near? And you go all the way out and you think, okay, that was really, really bad. All right, so we start with each observation own cluster, and then we're going to group them into larger non-overlapping clusters, and then in the end they're merged into a single cluster. So you can imagine, here, let me go back here. Let's start with that green. Let's look at the left hand poor clustering. Let's start with that green one all the way to the left. Let's start with that one. If that's the cluster, if that's the centroid, and we go around and around, sooner or later, and hopefully sooner, the algorithm will say, you know what, that one stinks. There's no way that's a cluster. Let's start over again. And so it's going to pick each one, and then we're going to merge that into a single cluster. Now, divisive clustering is a top-down approach. So you start with one giant cluster, and then you just start estimating and practicing and partitioning randomly and saying, okay, let's do this one here as a cluster, and let's see what that looks like. And then let's do this one, and then, so what we do is we get smaller groups and smaller groups all the way down until each cluster is only its one observation, back to the beginning point of this agglomerative clustering, right? So we just do in the opposite way, and we try to figure out what those clustering. And so essentially what the agglomerative cluster and the divisive clustering approach, they ought to result in the same clusters, whether you do top down or bottom up. But here's the thing, and this is probably a great exam question, that sometimes there might be data sets that are, here, let me just go back here. Sometimes there are data sets that might be more inclined to use divisive and more inclined to use agglomerative. All right, let's move on to these final learning outcome statements. So what are we doing here? Neural networks, deep learning, reinforcement learning. All right, this sounds an awful lot like a Terminator movie to me. All right, so introduction here, neural networks. All right, so what do we have? We have an input layer, that's blue. We have a hidden layer, and that's the important layer right there. That's green, and then we have an output layer. And each of these layers, notice there are lines in between those, each of these layers are linked. Somehow they're linked. So the input layer might be all of my variables. The output layer might be something else, right? We don't know what that something else is just yet. All right, more terminology here. The input layer, in this case, consists of 3 features. The hidden layer consists of 4 nodes, and then the output layer consists of 2 output nodes. Now, a lot of times there could be just one output node, like, hey, yes, this is an overvalued stock, or it's not an overvalued stock. All right, once again, we've got to come up with this hyperparameter. And this is, as I said before, such a big challenge. And so the learning, this machine learning, this occurs in that hidden layer. And what it does is it takes this input layer and it learns from that input layer, and then it produces the appropriate output. Here's a cool picture of face recognition, and it's amazing. I mean, I've watched the Jason Bourne movies, and you watched the Jason Bourne movies, and we watched the at least I hope you have, and we watched the Mission Impossible movies, and maybe even the James Bond movies. So this pattern facial recognition is extremely important. But what does that have to do with our life here? So, this is really important for things like fraud. We've said this all along. So credit card fraud and other types of fraud. Deep learning nets. Oh, so here, let me go back up to that first circle, or that first arrow point up there. Many, many hidden layers. So excess of 20. There's another one of those numbers, but I would probably remember that number for deep learning. Now, reinforced learning. This is an algorithm that involves an agent performing actions that maximizes its rewards over time. All right, so what do? We observe the environment, we learn by testing new actions, and then we reuse those previous experience. Okay, so this is trial and error. So going back to my dividend example, and so we're trying to figure out how dividends play a role in the life of a corporation, and we have free cash flows. So we can do trial and error by saying, okay, free cash flows, Is it above this level? Is it below this level? And then we can say, all right, what's going to happen at the end? And so in the end, we're going to say something like, yes, free cash flow is important in predicting dividend changes, but we're going to do it in a much grander and a much more global scale. And so look at the purple arrow point there. A virtual trader can apply this reinforced learning in financial markets to maximize his or her profits. And so using just my simple dividend and free cash flow model. What else did I have in there? I had some leverage ratios or something. And that takes us through this. So hopefully you're getting the same sense that I tried to reveal to you at the very beginning. Look, this is mostly about supervised and unsupervised learning. The section on deep learning at the end was minor compared to those two. So look at LOSs 3 and 4. That's where I would focus my attention.